The program examines volatility as an independent factor exposure within alternative investment portfolios. Volatility represents the degree of variation in asset prices or returns over time, and is widely recognized as both a measure of risk and a potential source of return. Unlike traditional asset classes, volatility itself can be traded and managed through derivatives, structured products, and specialized investment strategies. The program emphasizes that volatility exposure behaves differently from traditional equity or fixed income risks, and often becomes especially important during periods of market stress. Investors use volatility-based strategies for hedging, diversification, speculation, and risk management. Understanding volatility dynamics is therefore essential for managing complex portfolios and evaluating derivative-based investment opportunities. Several measures of volatility are used to evaluate market risk and price variability. Historical volatility measures the standard deviation of past asset returns over a specified period and reflects realized market fluctuations. Implied volatility, by contrast, is derived from option prices and represents the market's expectations regarding future volatility. The program explains that implied volatility often changes rapidly in response to investor sentiment, economic uncertainty, and market stress. Volatility indices, such as the VIX, are widely used as benchmarks for market expectations of future equity volatility. Investors analyze both historical and implied volatility because discrepancies between realized and expected volatility may create trading opportunities, risk management signals, or indications of changing market conditions. Option Greeks, particularly vega, gamma, and theta, play an important role in understanding volatility exposure within derivative strategies. Vega measures an option's sensitivity to changes in implied volatility and is especially important for volatility traders because option values typically rise when expected volatility increases. Gamma measures the rate of change in an option's delta relative to movements in the underlying asset price, reflecting convexity and directional sensitivity. Theta measures the rate of time decay in option value as expiration approaches. The program highlights that managing these sensitivities is critical for options portfolios because changes in volatility, market direction, and time passage can significantly affect portfolio performance. Effective options trading, therefore, requires careful monitoring of multiple risk exposures simultaneously. Volatility is increasingly viewed as a distinct investment factor, rather than simply a byproduct of market risk. Investors may seek direct exposure to volatility through options, futures, swaps, volatility targeting strategies, or specialized hedge funds. Volatility exposure often exhibits low or negative correlation with traditional asset classes, making it useful for diversification and downside protection. The program emphasizes that volatility risk premiums may exist because investors are willing to pay for protection against adverse market events. As a result, strategies that systematically sell volatility may generate attractive returns during stable market environments, although they can experience substantial losses during periods of financial stress. Volatility therefore functions both as a hedging instrument and as a source of alternative return generation. Modeling volatility processes is a major focus within quantitative finance because volatility is dynamic and exhibits clustering, persistence, and mean reverting behavior. Traditional models, assuming constant volatility, often fail to capture actual market behavior during periods of financial instability. The program discusses stochastic volatility models and generalized autoregressive conditional heteroskedasticity (GRCH) models, which attempt to account for changing volatility over time. Volatility clustering refers to the tendency for high volatility periods to be followed by continued market turbulence, while calm periods often persist as well. Investors and risk managers use these models to price derivatives, forecast market risk, stress test portfolios, and design hedging strategies that respond more effectively to changing market environments. Implied volatility structures provide additional insight into market expectations and option pricing dynamics. The volatility smile and volatility skew describe patterns in implied volatility across different option strike prices and maturities. In equity markets, out-of-the-money put options often exhibit higher implied volatility because investors demand downside protection against market declines. Term structures of volatility also reveal how market expectations vary across time horizons. The program explains that understanding implied volatility structures is essential for options pricing, relative value trading, and volatility arbitrage strategies. Traders analyze changes in volatility surfaces to identify potential mispricings, hedging opportunities, and shifts in investor sentiment. These structures therefore play a central role in modern derivatives markets and volatility-based investment strategies.